So welcome to the Genus quarterly video. It's February 1st today. If you go into our Genus website, into newsroom, there is a summary of our seminar we put on 2 weeks ago, which is more in depth about what happened last year and what we're looking forward to next year. But today we'll just do a quick video on it. Wayne, the interesting thing to me is last summer, really the market, the economy went from recovery to expansion. And Trump came in and had more growth policies on the table, and so there was a real rotation that happened in the marketplace. What's going on?
Well, there was a late cycle rally, if you will, before Trump was elected, and that was reinforced, and that was industrials and resource-based areas all did very well. The banks and financials did very well after he was elected, just based on a higher long-term rates, steeper yield curve, banks make more money in that kind of scenario, as well as the talk of deregulation in that space. So the financials, economic sensitive names like industrials and resources all did well before and after the election.
Right, and the other huge thing that happened in the summer was it looks like maybe a bottom was put in place for long-term interest rates. Tell us about that in terms of what it really means for portfolios, the next 20 years versus the last 20 years.
Yeah, well, you know, it's the Fed is starting to tighten in the U.S. and they're ahead of the curve, ahead of the rest of the world, ahead of the Europeans and Japanese, and the Trump election or victory only reinforced that, and so rates backed up even faster. So we can say we believe that 10-year has put a long-term bottom in here in the U.S. Jury is still out in Europe, but there's been a lot of monetary easing there. And the economic numbers out of Europe have really beat expectations over the past 2 or 3 months. So they pumped a lot of money into the system in Europe over the past year. And I think it might surprise folks this year in terms of the growth prospects there.
One of the things we harp on is the currency volatility as a result of Brexit or the surprise Trump election, just what it does to the currencies. And next year we have elections all over Europe. We expect lots of currency volatility. How do we at Genus take that into account when we're imagining the money?
Well, the currency movements have been really quite volatile this past 6 months here. And right now we have, I guess you could describe it as asynchronous monetary policy around the world. The Americans are tightening. The Europeans are still easing, pushing on the gas. And that's why the dollar has rallied so much. But I think the numbers recently that came out in Europe were stronger than expectations, and that's putting maybe a bit of a lid on the U.S. dollar. But longer term, we think the pro-growth agenda that gets in will definitely help the U.S. dollar, and also the trade area will actually help the U.S. So from time,
what do you mean the trade area will help the U.S.?
The trade. I guess the trade agenda in the U.S. in terms of trying to bring more spending home. And more growth here will help the U.S. dollar longer term.
So the lack of trade.
Well, I guess
the more producing in the U.S.
But I guess, and here's the issue here. You know, in our quarterly pieces recently, we talked about currency volatility, and the currency seems to react faster to where the markets are going, and they've discounted maybe stronger U.S. growth versus the rest of the world, and they're actually going to make it harder for Trump to initiate or trying to solve the trade problem they have right now. So.
Of course, he's unprecedented in so many ways, but one of the ways is he is using moral suasion to try to talk down the U.S. dollar. Why does he do that?
Well, the U.S. dollar is really, if it goes up, it's really impacting his agenda. He's trying to reduce the trade deficit, and a weaker U.S. dollar makes it harder for him to do that. So him talking up future growth and future strength is actually, he's hurting himself. He's shooting himself in the foot effectively. So. Right. I think I predict that he's going to start talking down the dollar.
Right. Well, he has been.
So, and will continue to do so. But I think the dynamics at play that are in terms of monetary policy, they're way ahead of the Europeans. That's the Americans. And you know, if there is a big if the tax cut gets through and they repatriate, all that money is going to come here. There's going to be more capital spending. So it could drive the U.S. dollar
a lot higher
and really. Impact his policies. And I think it might be actually reminiscent of 1985 when, through the Reagan tax cuts, the U.S. dollar went very high, and they put in place the Paris Accord, which was a bit of currency manipulation and brought the U.S. dollar down.
Right. And so how does Canada fare in this expansion cycle, part of the cycle we're in with the U.S. doing what it's doing. How does Canada fare next year?
I think Canada doesn't do that badly, actually. I think if the global economy is going to improve, I believe, because of all the monetary policy out there right now.
Right.
That's, unless there's something that another Brexit type event in, say, in Europe, which could derail things. But there's been a lot of money sowed into the economy. We're going to get a payback this year on that, I believe. And Canada does well in stronger global economies. As well, we were lucky to be so close to the U.S. That's a positive thing, I would think. And as well, Canada doesn't have a surplus, a trade surplus with the U.S. We actually have a bit of a deficit.
Right.
So we're not going to be, I don't think Trump's going to be coming after.
We're not on his hit list.
Exactly. He's after Mexico.
Right.
So I think we're close. I think we're close to them, and I don't think we're not going to do that bad. And actually, the dollar reflects that. The U.S. Canadian dollar has been one of the strongest currencies since the election.
Yeah. So Canada also is driven by the price of oil, and it rebounded off $27 almost a year ago now. And I'm wondering how important this OPEC accord is that should get papered in March or April, and also Trump making the U.S. self-sufficient, more technology, cost of solar, the cost of energy going down, puts a lid on where the oil can go in Canada, and how does that affect the economics of Canada and our dollar?
Well, I think there was a lid on oil, and I think it's more like $60, $65 in that case. I still think we can go higher in this cycle. If the global economy improves next year, we can go higher in terms of oil. That can help Canada and help.
Is the OPEC accord needed to do that?
I think it's needed to do that right now, and hopefully the stronger economic growth and demand will push that higher next year.
Right. So I'll just remind people that we were actually pretty well positioned, probably too early. In March, more for expansion. And so when July came and Trump came in, our portfolios are well positioned
Yes.
in terms of banks,
Yeah.
growth, materials, no long bond, hardly any long bonds. Or do we see any further rotation now? We're looking forward into 2017?
In terms of where we are right now, we're in the last part of the cycle. And in last parts of cycles, typically industrials, resources, and financials do well, and they are. And I think the cycle is elongated, and this late cycle can be more protracted and go through all of 2017, at least I would think. And we think the Trump pro-growth agenda, if it all goes through, is a good thing. But on the other hand, there are risks in terms of the trade thing. Will he start a trade war? Or there's going to be
Will he talk a world war?
So there's a lot of good things happening in terms of growth, in terms of, I think, on the fiscal side of the U.S.
But there's
also,
flies in the ointment.
There's also risk out there as well,
Yeah.
and so right now we focus on what we can do, and we want to see the programs as they're rolled out.
Right.
What is going to be the tax plan as we see it? So there's so many uncertainties.
Right.
But for now, we're playing the late stage cycle, and we're neutral in terms of equity, and we'll see where it takes us.
Great. Well, please give us a call, talk to your portfolio managers, and we'll see you next time. Thank you.
Thank you.